Welcome back to Insights Now. I'm David Kelly, Chief Global Strategist here at JP Morgan Asset Management. We start our Moments in Market History series joined by Katie Korngiebel, a research analyst on our Market Insights team, to discuss the stock market crash of 1929. Welcome, Katie.
Thank you for having me.
So we're going to talk about the 1929 crash. So to start with, can you summarize in a sentence or two what the 1929 crash was all about?
So, I think it was our first big example of speculative excess. So, it started with this, very real story about economic prosperity in the Roaring Twenties and, new inventions like the radio and cars that really made people feel like we were entering a higher plane of economic growth. So, it was a real story that kind of ran away into excess as people got, so excited. And then they viewed these like higher prices as confirming evidence. So, it ran away from us and then obviously eventually popped and led to the Great Depression.
Hmm. Yeah, absolutely.
So,
Pretty dramatic.
yes, very dramatic. So, David, I think from that, there were, very real strong points for the 1920s economy. So, can you talk to us a little bit about what was real and where did investors get overly optimistic?
Absolutely. I think this is true for all the sort of speculative episodes we talk about, whereas there is actually a genuine story here and just goes to seed at some stage. So 1920s were, they called them the Roaring Twenties for a reason. If you look at vehicles on the road, there were about 8 million cars on the road at the start of the decade. There were 23 million cars at the end of the decade. Movies. Um, I was amazed to find this out, but in 1929, 90 million movie ticket sales were occurring every week.
No
Now,
way.
in a country of 120 million people, basically everybody was going to the movies every week.
Wow.
But you also saw you saw the introduction of radio. There were no radios essentially in 1920, and by 1929, about 35 to 40% of the population had a radio in their house. So we had huge economic growth, about 5% economic growth from 21 to 29. We did have some recessions along the way, but average economic growth was huge. But more than that, I feel like this was a decade in which America really came together in a dramatic fashion. If you think about what vehicles did, or what movies did to the popular culture, or what radio did to people's ability to access the same information at the same time. So it truly was a revolutionary time in America. And it's not surprising people got a little bit excited.
And the other thing that they were, really excited about was the idea of stocks as a, way to become permanently wealthier. So it was kind of one of the first times retail was sort of crowding into the market.
Hmm.
Can you talk to us a little bit about, sort of the start of retail investing and why people just got so excited?
Well, I mean, it started, of course, with a good economy and then very good stock market gains. So we had, really strong gains. Yeah, it was sort of up and down in the first part of the decade, but then you had really strong numbers in 1927. 1928 was an absolute barn burner of the stock market. It was up almost 50%. And even in 1929, for the first 8 months or so, the market was up very strongly. And of course, these rising markets, and with events like the radio, people hear about it. They hear, people who are presumably no smarter than they were making a fortune in the stock market. So I think it became very fashionable to invest in the stock market. It was also a very gilded age in terms of wealth, much like today. I mean, the wealth concentration was dramatic, and what we know from today is that while the average person is basically living paycheck to paycheck and doesn't have a lot of money to put in the stock market, the wealthiest in America did have a lot of money to put in the stock market, and so they did this. And the more the market went up, the more excited people became about it. And then we also had things like investment trusts, which really expanded the opportunities for the average investor, the average person to get in the stock market. So I think that just spread the sort of the stock market culture in America.
And I think one of the really interesting things it was sort of like a overall psychology, right? And as the market continued to go up, over the course of years, people who were more cautious and, kind of the
Hmm.
naysayers started to look like the not so smart ones in the group as things kept going up.
Yeah.
So there's this like self-fulfilling prophecy.
Yeah, I remember in high school reading The Great Gatsby, and that was in 1925, and it was sort of like that. I mean, it was just this exuberant party
Uh-huh.
going on. There may have been some not great things going on beneath the surface, but the
Uh-huh.
people were genuinely excited about
Yeah.
making money in the stock market. Of course, they had no particular. There were other bubbles in America. There was a rather famous Florida land bubble, where of course, we've had bubbles in real estate in Florida before. So Americans are a little bit prone to speculation
Yes.
as a people. I mean, I think America takes our forefathers and foremothers had a certain amount of um, a pretty aggressive and optimistic attitude just to arrive in America in the first place, and that sort of is part of the culture. But it certainly was very much part of the culture in the 1920s, and people just jumped in with both feet into the stock market.
And I know the land bubble was kind of one of the first things that showed, people and started this belief that everyday Americans could get rich from buying an asset and holding it.
Well, yes, and you read the book. It's a great book, the Great Crash
It is a
1929 by
great
John
book.
Kenneth Galbraith. And I remember he uses lots of antiquated language, but one of the great words he uses, the usufruct of an asset, and the usufruct of an asset is the use or income or whatever you do with the asset, as opposed to just the price. And in the Florida land bubble, people forgot all about the land. It was just how much they could sell it for. That's kind of what happened in the stock market too. Dividends became
Yeah.
less important. People just want to buy and sell stocks as the stocks went up.
Yeah, but again, like it was a very believable, plausible story that the market was going up when everybody was surrounded by all
Yeah.
of these fancy new glittering technologies.
Yeah.
And I think the other thing that made it believable is public officials weren't necessarily saying, like, hey, we might have gotten a little over our skis here, right? They were kind of reinforcing the narrative. And so it was, the smartest people in the room, politicians, businessmen, bankers, reinforcing this public narrative. Can you talk to us a little about the state of institutions at the time? And, maybe they recognized it was a bubble, but why was it so hard to intervene?
Well, I think that's true. I mean, first of all, the political class in Washington, of course, wanted to promote this under Coolidge and then under Hoover. They wanted to, if the stock market was doing great, that was a sign the economy was doing great. Everyone was getting wealthier. Their own friends were getting wealthier. They were getting wealthier. So why on earth would you call an end to the party? Even if you thought there was an excess or a problem, nobody's going to thank the person who basically takes away the punch bowl and cause the party to come to a crashing end. And at some stage, they realized it was going to come to a painful end, and so they didn't really want to do very much about it. But it wasn't just that; they didn't have the tools to really do anything about it without a lot of effort. I mean, the Federal Reserve was an there are a lot of things that we take for granted today that just weren't there. You could borrow on 10% margin. So I could give you $100 and you could buy $1,000 worth of stock for me on that. And of course, that meant if the stock market went up, I could make a fortune very quickly. But if the stock market went down, I had very little to protect me, and the margin calls would come out quite quickly. But the Federal Reserve didn't set margins back there. They had no. They didn't do anything really to limit short selling. That was seen as a very respectable profession. There were pools and there was insider trading. There was a lot of manipulation of the market. None of this was a lot of this was later on ruled illegal, but new laws were passed, particularly the Securities Act of 1934. But at the time, there were very few regulations that either the administration or the Federal Reserve could actually call on to try to put an end to the bubble.
So I think two things that you've kind of mentioned that I think are worth drawing out, and something I didn't know before I read the book, but there was a lot of fancy financial footwork going on, even back in the 1920s. So we talked about margin investing and then also the investment trust. So
Yeah.
these two kind of devices, financial devices that added leverage to the bubble. Can you talk to us about both of
Yeah, the
those?
investment trust was a particularly unfortunate one for the average investor because the concept was it was just pure leverage. I mean, the descendants of this are pretty soberly run mutual funds, but at the time the whole key was leverage. So what you would do is you would set up an investment trust and you take in say $50 million from investors, but then you'd borrow another $100 million either through bonds or preferred stock, which is essentially the same thing as bonds. And so now you'd be able to put $150 million into buying stocks. So if you were the investor in this, you had you could make three times your money on the way up, but three times your money on the way down. And then there was a notorious case of Goldman Sachs Trading Corporation, which not only launched a investment trust itself, but then invested in another one, which invested in another one, and so they managed to sort of achieve something like 10 times leverage on it. All works wonderfully well on the way up, but it was very painful on the way down.
Yes, it's like the Warren Buffett quote that I think we all love so much is it's only when the tide goes out that you can see if people are wearing swimsuits or not.
Yes, exactly.
If you're here for the why behind market turning points, Alternative Realities brings that same approach to alternatives, spotlighting the shifts reshaping the alternatives landscape. Hear from industry experts and distinguished guests on the strategies and trends shaping the future of alternatives. Listen to Alternative Realities today, available wherever you get your podcasts.
And I think, the book, it calls it something funny. The chapter about this is called In Goldman Sachs We Trust. And I think that's something that's kind of common in all the crashes that we'll talk about this season. But it all feels very rational at the time, right? Kind of all of these fancy mechanisms legitimized it and they made it look very official and very real and very safe. But only after do you kind of realize it was the most dangerous thing.
Well, that's right. And of course, in retrospect, even when the stock market crashed, nobody had a reason to believe that it was going to be that bad. I mean, it took essentially 3 years for the market to find a bottom. And when it did, it was down by 89%.
Wow.
I mean, so if you start out with $1, you had 11 cents left for the whole market. And many, many stocks, of course, basically disappeared altogether. But it also triggered the Great Depression, which sent the unemployment rate up to 25%. So you had and you had massive deflation. So it really triggered the very worst. And it wasn't the only cause, but it triggered the very worst of economic times. So looking from that lens, it looked like extraordinary speculation. By today's measures, actually the PE ratio in 1929 wasn't as high as it is today.
Wow. So I think sticking with that, can you talk to us a little bit about the mechanisms that kind of take, a stock market crash into, a slower economic growth and eventually a recession?
Yeah, there were a number of things that went wrong after the stock market crash. The first thing is the stock market crash was particularly cruel because particularly because of the margin issue. There were so many people buying on margin, and because the investment trusts where people would just suck money into the market, which wouldn't otherwise be there. The market kept on stabilizing and then falling again. And so you might feel like the guys who bought in August were crazy, and you got back in November and you decided to pick up some bargains, and then you got sold out. And it went on and on and on all the way to July of 1932. So
At first, people were buying the dip. They
oh, they're
saw the decline as a new
they're
opportunity.
and they're buying the dips and they were sort of buying the crashes. I mean, if the stock market's down 50%, you kind of think, maybe there's some value here. So it went down 89%. So it just ruined people over and over, which was very tragic. So I think that drip, drip, drip obviously was very negative. I think another thing that was very important is, as I said, income was very unequal at the time. And because it was unequal at the time, the spending of the rich and the investment of big companies was really important to how the economy was doing. Kind of like today. So when they all took a bath, when the richest households took a bath, that really hurt the consumer spending overall. But there were other things. I think the fact that we had the biggest problem was the banking system, because we had actually bank closures all the way through the 1920s, but of course it accelerated in the Great Depression. And as there were runs on banks, nobody's money was protected. So if the bank in the next town went down and you weren't sure about this bank, best thing to do is get your money now. That caused bank runs, which of course was ruinous to commerce, but it also led to deflation because the money supply contracted. Now, if prices are falling, and they did fall in 1930 and 1931 and 1932, but if the price level is falling by 10%, why do you want to invest the money at all? If you just stuff it under your mattress, don't tell anybody where it is, it's going to be worth 10% more in a year's time. So it really caused a pulling back. It's one of the great evils of deflation was how it exacerbated the Great Depression. There are other things. We put in tariffs. The Smoot-Hawley tariffs in 1930 was to try to protect our domestic manufacturers. The problem is it killed U.S. exports because it killed all those countries over there, and so it managed to transmit the recession around the world. So I think that was another part of it. And then you just had economic orthodoxy. Everybody said, well, the first thing we need to do is balance the budget. Why? I mean, if you don't have enough demand in the economy, the last thing you need to do is raise taxes or cut spending. But both Democrats and Republicans actually, just after the stock market crash in 1930, 1932, when Roosevelt was running for election, he was talking about balancing the budget. Only after the fact they realized, what, maybe that's not such a good idea. Maybe you ought to do some public works and spend some money. And in fact, the Great Depression didn't, we still had 17% unemployment in 1939.
Wow.
because the unemployment rate came down slowly, then bounced up with another big depression, 1937. The only thing that actually cured the economic malaise was when we were forced to spend money that we knew we couldn't afford on World War II, and that mobilization in World War II pushed the unemployment rate all the way down to 2% by I think it was 1941, and that ended the Great Depression. But in the end, the solution was massively increasing demand, and unfortunately, the stock market crash triggered this huge reduction in demand.
So we know now that, one of the best things that the government can do is kind of spend money to get us out of something like that. But as you point out, that wasn't clear. So we have learned some things. And I know you mentioned that the Great Depression triggered some regulation changes. So I guess what has changed now? And is it enough to prevent another 1929 style crash?
Well, there's a great book which wasn't on the course called "Reminiscence of a Stock Operator"
Next time.
by Edwin Lefebvre, and it's basically the great thoughts of Jesse Livermore, who was a notorious stock market shorter. Actually, he shorted markets, and he made a lot of money, and he went bankrupt too. Very colorful character, but he used to talk about financial mistakes, and he said, if you make a big mistake. And it's very painful. The more painful it is, the more you learn from it. You won't make that mistake again. The problem is the family of mistakes is a very large one with lots of uncles and cousins just around the corner to get you. And so I sort of see that today. Yes, we're not going to have the same kind of banking crisis because of FDIC insurance. And frankly, we've got much more aggressive monetary and fiscal authorities at work. But there is still plenty of speculation going in the stock market right now. There's still plenty of people buying companies which they have no clue as to what does this company do. They have no clue what the valuation should be or the prospects are, but they're pouring money in because everybody else is making money out of it. And we're seeing that not just in the stock market, many other assets. So I think it's very hard to dampen down speculation. It's very hard to eliminate margin buying and leverage. So I think the message for investors is still be careful. Look at valuations. Look, does it make sense? You don't have to know everything about the technology, but does it make sense? In terms of valuations, and think about leverage, think about diversification, because one of the great sad points about this is the big difference in the 1930s was, were you all in the stock market in 1929, or did you have a nice diversified portfolio with some bonds and stock? If you had lots of government bonds at the time, they kept on paying 3% interest or whatever, and it would you'd have been hurt, but you would have been fine.
Think also the duration that these, stock market skyrockets can go on for, right? So if it's, 1 year, maybe you think, oh, well, it's gonna, pop soon. But if it's something like 3, 4, 5 years, like we saw now, it's very hard to believe, that it was a myth all along. And especially when it wasn't, they started from a true place, but
Well,
it can just go on for so long.
that's right. As um, I think as a friend of ours, Jordan Jackson often says, pessimism sells, but optimism pays. And a lot of people have gotten paid in the last few years, and that does make it hard for people to sort of pull back from the market.
Especially when we're using these new technologies and they really do feel so amazing and
Exactly,
we
and
know they're going to change the
so we
world.
know how it felt 100 years ago.
We really do. Well, David, thank you so much. You should be careful. You know so much about the Great Depression. People might start thinking you were there.
I was not. I'm younger
We're
than
not,
that.
but I certainly learned a lot. So thank you so much.
Thank you, Katie. And thank you all for joining us on our Moments in Market History series. Be sure to come back for more discussions on key moments throughout market history.
This material is for information purposes only. The views, opinions, and statements of financial market trends that are based on current market conditions are those of the speaker and may differ from those expressed JP Morgan Asset Management or by other areas of JP Morgan Chase & Co. Any companies referenced are shown for illustrative purposes only and are not intended as a recommendation. We believe the information provided here is reliable, but should not be assumed to be accurate or complete. The views and strategies described may not be suitable for all investors. This content is intended for information only based on assumptions in current market conditions and are subject to change. No warranty of accuracy is given. This content does not contain sufficient information to support investment decisions. It is not to be construed as research, legal, regulatory, tax, accounting, or investment advice. Investments involve risks. Investors should seek professional advice or make an independent evaluation before investing. The value of investments and the income from them may fluctuate, including loss of capital. Past performance and yield are not indicative of current or future results. Forecasts and estimates may or may not come to pass. JP Morgan Asset Management is the asset management business of JP Morgan Chase & Company and its affiliates worldwide.